We're going to begin a series of short videos that review indicators used by chartists when trading in the market. Even if you've been trading for a while, these simple and short refreshers can really help. In order to truly explain how to use these indicators and in order to consistently make money in the markets, it's imperative to learn how to identify an underlying trend and trade around it accordingly. So today we're going to go over trends really quickly, just an overview for using multiple time frames to determine trends. What is a trend? A trend is the general direction of a market or of the price of an asset. Learning to identify a trend properly can greatly increase your profitability. Here in this example, you can clearly see that the primary trend is up, which is confirmed by the 200-day moving average, also moving up. There are multiple types of trends. Trends can be classified as primary, intermediate, and short term. And if you want to figure out how to find these trends, you'll need to look at different time frames. There are almost always conflicting trends within a particular derivative, depending on the time frames being monitored. So earlier we were looking at this exact same chart that showed an obvious uptrend. You can see here that there's a downtrend. Move into shorter time frames, it's a larger downtrend. This downtrend is almost a month long during a primary uptrend in the market. So what time frame should you be monitoring? First, let me say, actually, it's not out of the ordinary for whatever you may be trading to be in a primary uptrend while being in a counter trend in immediate and short-term downtrends. You need to be able to determine the primary trend in the longer-term charts, which will allow you to be more consistent and profitable. Alternately, traders may be trading the primary trend but underestimating the importance of refining their entries in an ideal short-term time frame. And this can have just as much positive or negative impact on your trading, which is why we're doing this multi-part series on basic indicators. All right, so back to where we were. What time frame should you be tracking? A general rule is that the longer the time frame, the more reliable the signals that are being given will be. As you drill down in the time frames, the charts become more polluted with false moves and noise. So ideally, traders should use a longer time frame to determine the primary trend of whatever they're trading. Once the underlying trend is defined, traders can use their preferred time frame to define the intermediate trend and a faster time frame to define the short-term trend. So let's move on. Let's just say, for example, a swing trader here. What we're going to give examples of the time frames that a swing trader could use to determine trends and make the best entries and exits. A swing trader who focuses on daily charts for his or her decisions, as you see here in the same chart we were using before. This is a downtrend on the daily. That same swing trader would use the weekly charts to define the primary trend, which is upward. And then again, that same swing trader could use a 60-minute chart to define the short-term trend. So we see here that if you add those three charts together, you would have noted that the primary trend in the weekly was up. The intermediate and short-term trends for the daily and the 1 hour were down. So that can give this trader the assumption that they're in a counter trend. The primary trend is up, but we're in a counter trend. So this would be a good time to add to their position. Once a short-term chart enters an uptrend, which can be verified with moving averages, as you see here, you should be prepared to add to your position in support of the primary trend and back to where you were. So here on the 60-minute, this is the shortest term. This trader starts to see here midday from the 16th to the 17th, the shortest moving average begins to point upward, followed by a bullish cross over a longer moving average. Then this moving average begins to point up the next day. That's two moving averages now pointing up and in bullish direction. Finally, a few days later, we see that we have another bullish cross of a shorter, the 50 moving average over the 200. And now all three moving averages are in bullish order from shortest to longest, and they're all pointed upward in a bullish fashion. As soon as the intermediate trend begins its shift to meet the others, as you'll see here, this is the daily, which is the intermediate, the chart that a swing trader would typically be watching. We'll see here on the 22nd that the shortest begins to move up, giving a bullish cross the next day. Then this primary trend line is still up. This trend line is up, and now we have another bullish cross, and all the moving averages return to bullish fashion and in proper order. This would be the time when you would begin you would feel completely confident in returning to your full primary trend trade position. A day trader could trade off the 15-minute charts, use 60-minute charts to define the primary trend, and a 5-minute chart or even a tick chart to define the short-term trend. A long-term position trader, more commonly called a buy and hold, would focus on weekly charts and use monthly charts to define the primary trends and daily charts to refine their entries and exits. The selection of what group of time frames to use is unique to every trader. Ideally, traders will choose the main time frame that they are interested in, and then choose one above it and below it to complement that main time frame. As such, they'd be using the long-term chart to define the main trend, the intermediate term chart to provide a trading signal, and the short-term chart to refine their entries and exits so they get the most bang for their buck. One note of warning, however, is not to get too caught up in the noise of short-term charts and overanalyze a trade. It is vital to remember that the longer term the chart, the more gravity it holds. Please come join us at Gray Trading School, and you can have a 5-day free trial and join us for a noise-free, friendly, and productive environment and continue learning more with all of us. Thanks a lot.